January 2, 2017 Real Estate Capital Scoreboard January 2017. Chicago, Illinois, January 2, 2017, mortgage rates shifted upward for the 9 consecutive weeks. The real estate capital markets welcome the new year, anticipating additional rate hike throughout the year. Last month's 25 basis point rate hike allowed the Fed dampen an improving economy backed by steady employment growth. This rate hike was the only one of the year and second this decade. Furthermore, the Fed published economic projections revealing their desire to hike rates 3 more times in this new year. Today's rate hike expectations have the following impact on capital markets. Mortgage rates: think 4% handle on any type of long-term debt, even at lower leverage. Current rates are at levels similar to the first quarter of 2014. From a historical perspective, rates are within their lowest levels of the past decade. And spreads continue holding steady, or slightly declining, depending upon individual lender appetite. Most lenders have reasonably robust funding objectives for this year, so pressure for tighter spreads continues, especially for lower leverage and higher quality CRE financing opportunities. Valuations: a delicate balancing act of paying more for debt, but potentially trading up for higher cash flow due to inflation keeps real estate prices near peak levels. Demand for credit tenant, net lease properties via 1,031 exchanges, as well as a limited supply of quality CRE assets assures low capitalization rates within the current market cycle. Alternatively, attractive purchase opportunities will emerge for those properties requiring repositioning based upon fresh capital reflecting higher rates than seen over the past few years. Equity risk: investors hope that Fed policies extend the currently favorable economic cycle as long as reasonably possible, perhaps a couple more years. Recent business cycles, for example, the Great Recession, created overheated conditions with punishing results afterwards. In the current cycle, slightly higher interest rates dampen asset overvaluations. Also, recent financial regulatory pressures discourage lenders from allowing too much leverage for riskier investments. More so than ever, investors need greater amounts of equity capital to backstop risk, leading to more cautious deal-making. Ms. Jean Peck of the Real Estate Capital Institute predicts realty capital market fluctuations bring attractive investment opportunities to well-capitalized and patient buyers. Motivated sellers will accept lower prices, especially on deals that have been retraded because of rising rates.
February 1, 2017. Real Estate Capital Scoreboard February 2017. Chicago, Illinois, February 1, 2017. The 20,000 Dow threshold starts the 2017 on a hot streak. Realty capital markets, however, are more subdued as mortgage rates are slightly lower than the beginning of the year. After bouncing about a quarter point during the month, overall long-term rates are certainly higher than pre-election figures, but still within a comfortable range. Lenders are flush with funds per the following popular sources. Agency: FHA, Freddie FNMA. Combined agency loan production for last year was at a record level, in excess of $110 billion. Significant liquidity assures mortgages spreads will be tight and perhaps even compress more as the year progresses. On the legislative front, the new administration is targeting tax reform, potentially impacting tax credit-driven deals. New construction/perm debt combinations, for example, FHA/HUD 221D4, gain more popularity as many banks pull back from new multifamily construction fundings. Life Company: similar to agencies, mortgage spreads are on an even course. Life is actively in the market with funding allocations similar to last year. Ideal underwriting focused on 65% or less leverage in return for very attractive pricing of 150 to 180 basis points over treasuries. Unique to this funding sector, fixed-rate forward delivery loans reach out to a year at premiums of 3 to 5 basis points per month after the initial 90 days. CMBS, securitized mortgage spreads, too, have been stable during the past few weeks. Risk retention rules governed by the type of risk compliance chosen by individual conduit lenders. Larger financial institutions issuing conduit debt, and investing in each layer of the debt stack, vertical strip, appear unaffected. Alternative risk compliance formats, horizontal strip, targeting the highest risk portions of the debt are still defining securitization strategies. Bank, Basel III regulatory requirements postponed to late in the first quarter, giving banks breathing room for regulatory negotiations on some of the more onerous provisions. Even after considering regulatory issues, construction funding is challenging, given the new inventory pipeline in most markets. Loans are limited to lower leverage and debt yield thresholds with strong sponsorship, mostly for existing clients. Ms. Jean Peck of the Real Estate Capital Institute advises, most of the attention is diverted from rates to how Trump administration will deal with loosening tax and financial service regulations. Lenders and borrowers alike want more policy clarifications in order to formulate investment goals and objectives.
March 1, 2017. Real Estate Capital Scoreboard-March, 2017. Chicago, Illinois, March 1, 2017. The commercial mortgage lending industry held its annual conference, CREF, in San Diego this month, with industry veterans remaining very bullish on the funding goals and objectives for this year. In summary, an abundant supply of capital combined with conservative, yet competitive underwriting summarizes the state of the market. Some of the key comments shared by lenders include the following. We have more money than deals. Most funding sources have same allocation as last year. CMBS lenders expect to be very active, but only at profitability levels that accurately reflect risk retention. For the right deal, we'll win on pricing. Life insurance companies clearly lead the industry as far as pricing, with the lowest spreads dipping below 130 basis points over the 10-year treasuries for lower leverage opportunities of 50% or less. For example, spreads just keep tightening. Mortgage spreads over treasuries are narrowing, but intense pricing competition remains for lower leverage offerings. Typical loan pricing at 65% LTV fall comfortably below 200 bits per second. 75% LTV, but on my #s, some lenders concerned about peak pricing level use internal underwriting restrictions such as capitalization rates with floors. In these instances, leverage levels of 65% are normal and 70% or more is considered high leverage. Apartments still attract up to 80% LTV. Can't get enough apartments/industrials. Capital sources demand more multifamily and industrial properties to balance out their portfolios, as these are the two most favored categories. Apartments for cash flow stability and industrials for diversification. Not just a one-trick pony. In addition to balance sheet lending, life insurance companies are teaming up with private and public capital sources for placing debt and equity through fund management vehicles. Gumby prepayments. With rates close to record low levels, lenders compete by offering extremely flexible prepayment privileges for fixed and floating rate loans, for example yield maintenance and declining balance instead of defeasance. John Oharenko, a director of the Real Estate Capital Institute, observes, lenders are awash with cash, but still maintain funding discipline in light of regulatory oversight and industry oversight. Even as rates stay low and leverage levels tighten, most lenders will still stretch for the right deal.
April 3, 2017 Real Estate Capital Scoreboard-April, 2017. Chicago, Illinois, April 3, 2017. Most of March, benchmark rates marched upward in step with the second Fed rate hike prompted by continued economic growth. Due to hawkish Fed statements, pundits expect rates to reach a 3% handle for longer-term debt based upon the current trajectory. In the face of rising rates, and correspondingly lower financing demand, how are various funding sources retooling to remain active? The following summary tackles key players active in the permanent financing arena. CMBS. Numerous borrowers with maturing conduit debt are unable to effectively restructure their loans per currently stringent underwriting requirements. Major financial institutions and banks issue bonds, keeping the vertical strip and maintaining strong relationships with horizontal strip investors per risk retention guidelines. Pricing is tighter, resulting from higher quality loan offerings. Leverage up to 75% is available for premium deals, but 70% is more common. Agencies, workforce and affordable are the two most important words when discussing best pricing and terms for multifamily housing with the agencies. The GSEs are very focused on meeting their housing goals, as well as energy efficiency to various green program discounts. Discussions surface about more creative options including construction loan and pre-stabilization funding. FHA/HUD. HUD continues to offer the most attractive leverage and pricing. However, the longer closing timeline is the major factor influencing borrowers seek traditional financing alternatives. Some of the more competitive seller/servicers now offer bridge to HUD funding options to allow more borrowers to use interim debt while the HUD funding process is in play, expanding the possibilities for using this financing vehicle for property acquisitions. Life companies, armed with ample allocations of mortgage funds, LifeCos offer the best rates, in return for providing lower leverage. Lower 100 basis point spreads are surfacing, as spreads tighten between competing LifeCos. Longer-term dollars are plentiful. Multiple players supplement or highlighting their transitional bridge product. Banks, the most traditional construction and short-term lenders, banks, stay focused on compliance within a more restrictive regulatory environment. Cautiously active on new construction with lower loan-to-cost fundings generally reserved for the best customers. Pricing is still very favorable, starting spreads of 300 basis points over LIBOR. Term loans up to 7 years are available for balance sheet lending, although interest rate swaps will be required to protect fixed rate risk. Small regional and community banks may be more aggressive on term and leverage, but generally limited to loans of $15 million or less. Debt funds, helping borrowers with loans that the aforementioned funding sources find challenging. Debt funds provide higher leverage needs and more structured funding such as preferred equity, mezzanine, and bridge loans. Pricing is 100 to 300 basis points or more versus regular sources. Ms. Jean Peck, director of the Real Estate Capital Institute, states debt funds and smaller community banks are the sources to watch for more flexibility, leverage as more creative underwriting solutions are needed, instead of tighter pricing restricted by lower leverage.
May 1, 2017 Real Estate Capital Scoreboard-May, 2017. Chicago, Illinois, May 1, 2017 Overseas shock events in North Korea, Turkey and Syria spread market jitters, as investors flock to the safety of U.S. government treasuries. Even with the Fed's policy to control inflation with interest rate hikes, longer-term treasuries stubbornly move downward to levels not seen since last fall. Borrowers keep winning under such circumstances, capturing permanent fixed-rate debt within the higher 3% range to the lower 4% range for most types of conventional loans. However, shorter-term rates also start with a 3% handle, since floating-rate indices move in tandem with Fed benchmark rates. More specifically, even as Treasury notes dropped about a quarter point since the beginning of the year, 30-day LIBOR rates rose by about the same amount. A flattening yield curve is the result. Long rates are the sweet spot in the realty capital stack. The markets are flooded with capital and no shortage of real estate debt exists. Yet lenders are more cautious given the current point in the economic cycle, and more equity is typically required to attract decent financing terms. The longer-term lending market based upon the lowest rates is dominated by life companies. Agencies comfortably capture multifamily loans, often providing attractive pricing/leverage combinations and programs to foster value-add in affordable housing. Conduits focus on larger single-asset securitizations and higher-yielding loans that are not good fits for lifecos/agencies. Debt funds provide higher leverage and more structured fundings, especially bridge loans for asset repositioning situations. Banks fund new construction loans, but at more conservative levels than in the past few years. As for product type, investors continue clamor for multifamily assets this year, with private funds overwhelmingly dominating the market, representing nearly two-thirds of the market share by some estimates. Foreign investors are in on the party as well, especially in gateway markets. All in all, while interest rates have climbed since the election, the impact on pricing has been minimal for institutional quality properties. The Real Estate Capital Institute's director, Gene Peck, advises, global issues help flatten the yield curve. International demand for safe haven long treasuries have kept yields stubbornly low. A real benefit for permanent fixed-rate borrowers.
June 1, 2017 Real Estate Capital Scoreboard - June, 2017. Chicago, Illinois, June 1, 2017. The day the rates stood still would be the title of a real estate finance sci-fi thriller describing the state of the capital markets. Over the past month, numerous trading days resulted in the same rates as the previous days, a pricing pattern not seen any time earlier this year. The reduced rate volatility indicates the markets expect relatively modest rate hikes in the next few months. In capital markets awash with investment funds, such conditions favor tightening mortgage spreads as rate hike fears calm. The overall flight to higher quality, safer fundings creates even more pressure to tighten spreads due to the limited supply of such lending opportunities. As the domestic economy keeps humming along at the currently favorable pace, expect long-term mortgage spreads, the investment-grade assets with lower leverage, to reach down toward the 100 basis point range. Today's lower debt costs come as tremendous relief to the industry given numerous other issues facing owners. For example, in certain pockets of the U.S., rents are difficult to maintain and increase within the apartment sector due to the onslaught of new supply. On the commercial front, disruptive technologies and changing consumer habits place relentless pressure on retail and office properties to integrate bricks and mortar with internet spending habits. As was a common theme at the International Council of Shopping Centers major RECon 2017 event, it is not a question of retailers needing to sell via bricks and mortar as opposed to online. The question is how to optimize using both. Finally, operating expenses for all property types are rapidly escalating due to higher labor and material costs. In the end, owners must allocate more funds to operating, over and above debt service. Ms. Jean Peck of the Real Estate Capital Institute notes, steady debt pricing is welcomed relief for the industry. Instead of worrying about rising debt service costs, owners can allocate more spending on technologies that improve income while reducing expenses.
July 1, 2017 Real Estate Capital Scoreboard - July, 2017. Chicago, Illinois, July 1, 2017 Fed fighting is a popular sport today as the Fed and bond investors spar over interest rates. The Fed's quarter-point rate hike last month did minimal damage to long-term treasuries, only rising about 15 basis points on 10-year notes. The Fed firmly believes that tight labor markets will continue to fuel inflation. On the other hand, investors see modest economic growth combined with less government spending, looming tax cuts and lower energy prices. The second Fed rate hike has done minimal damage to CRE borrowers. Mortgage pricing persists at favorably low levels in line with relatively flat yield curves. Spreads stay somewhat unchanged as lenders scramble to find applicable funding opportunities. This has been the case for much of the past few years. Lenders cautiously limit new construction dollars, keeping property supply in check as demand rises with a steadily improving economy. Longer-term mortgages can still be fetched starting around 4%. Lenders flush with cash are cautious on property quality, but generous on mortgage rates. As lower leverage pricing remains in the lower to mid 4% range for many loans, Properties with higher risk/reward profiles capture rates starting at 5%. Very entrepreneurial funding opportunities can still be funded in the single-digit range, including higher loan leverage ventures of up to 85%. Developers are venturing into other property types above and beyond multifamily projects, as pricing peaks, even for marginal deals. Furthermore, suburban properties of all types attract more attention as urban infill investments are priced to perfection. Expect lenders to be more receptive to office and retail properties, in general, as portfolio diversification is becoming an issue. Mortgage pricing for these alternative investments should be competitive, especially if projects can demonstrate solid cash flows. The Real Estate Capital Institute's director, John Oharenko, argues, low mortgage rates are here to stay, as bond investors see fewer attractive investment opportunities. CRE fundamentals continue on a solid track, assuring steady demand for mortgage debt backed by reasonably predictable cash flow.
August 1, 2017. Real Estate Capital Scoreboard August 2017. Chicago, Illinois, August 1, 2017. A busy summer in the capital markets, as the Dow Jones Industrial Average flirts with the 22,000 benchmark as a new record. While stocks rally, interest rates are trending downward, worrying some Fed watchers. These experts warn about bond markets witnessing a correction soon. They argue that historically low debt yields will eventually collide with record-high equity markets, resulting in widening yields. No doubt, mortgage markets enjoy windfall conditions. Rates are slightly lower than a month ago, but mortgage spreads continue narrowing. Lenders still have abundant capital to place, even at such low rates. Funding different property types is one of the key underwriting components lenders use for increasing yields while balancing mortgage portfolios, as outlined below. Apartments, millennials and empty nesters seek urban living as major lifestyle choices, fueling an unprecedented growth in central business districts and surrounding areas. Most lenders favor this property type for steady performance based upon high occupancy rates typically ranging in the mid to higher 90%. Industrial/distribution, internet shopping forces a tighter supply chain as consumers demand quicker delivery of goods and services. Retailers morphing into distributors delivering products directly to customers, requiring facilities to be closer to client base, locations near more densely populated areas. Lenders clamor for any reasonable industrial deals, mainly for loan diversification. Limited funding opportunities of any scale exist within this sector. Office, astute investors return of suburban office deals due to very competitive pricing, but face many challenges in keeping high occupancy. Prime CBD deals still generate strong demand, as premier tenants want properties that have all the latest bells and whistles. Office underwriting driven by provable cash flow economics combined with conservative leverage. Retail, a tectonic shift is occurring in consumer shopping habits, as traditional retailers fight to survive by reformulating brick-and-mortar stores with online purchases. Major changes lead to new profit opportunities, but with inherent risks. Loan underwriting mainly focused on tenant credit and store sales for need-based shopping. Lodging, investor demand is slowing for both full and limited service hotels. Buyers and lenders are concerned about this property sector's volatility considering a peaking economy. Yet, high-quality sponsorship with strong hospitality relationships will still attract favorable loan terms. Mr. John Oharenko, member of the Real Estate Capital Institute, notes, everything is about high-density development, and lenders understand this very well. It's back to the future, as far as urban planning and development.
September 1, 2017 Real Estate Capital Scoreboard-September, 2017. Chicago, Illinois, September 1, 2017, Hurricane Harvey along with North Korea's missile adventures prevent the Fed from instituting any rate hikes soon. As expected, borrowers gain significant advantages by capturing low-priced debt due to such market conditions. Other notable observations include low inflation. Despite threats of rising rates, key economic indicators show that inflation is at its lowest point of the past 2 years. Last month the benchmark 10-year Treasury bounced about 20 basis points, landing to the lowest levels seen under the current administration. Short-term pricing indices. LIBOR reform takes the spotlight as far as benchmark pricing indices. British regulators announced the planned removal of the LIBOR index by 2021. Banks, agencies, insurance companies and other financial institutions have relied upon this index for decades. That said, few lenders are concerned since numerous indices emerge as probable replacements, including the broad Treasury repo financing rate, BTFR, and the bank prime rate. The more laborious issue focuses on financial institutions to modify documentation that corresponds to the new indices. New construction. Many funding sources are flush with cash for making construction loans. However, looming concerns about certain sectors of the commercial real estate market facing overbuilding, mainly multifamily, demand that banks and other construction lenders tighten underwriting standards, or even retrench from such opportunities. Yet the overall state of supply and demand is reasonably balanced. Retail and office sectors are limited to build-to-suit/per-leased properties, while industrial development remains healthy, including spec deals. Now more than ever, new construction opportunities are funded on a very selective basis, generally based upon lower loan-to-cost ratios of 65% or less. The Real Estate Capital Institute's director, John Oharenko, advises, even as short-term rates remain very attractive, the pricing gap compared to long-term rates is very tight. He adds, it clearly makes sense to explore long-term debt, but with favorable prepayment privileges, the best of both worlds. September 1, 2017 Real Estate Capital Scoreboard-September, 2017. Chicago, Illinois, September 1, 2017, Hurricane Harvey along with North Korea's missile adventures prevent the Fed from instituting any rate hikes soon. As expected, borrowers gain significant advantages by capturing low-priced debt due to such market conditions. Other notable observations include low inflation. Despite threats of rising rates, key economic indicators show that inflation is at its lowest point of the past 2 years. Last month the benchmark 10-year Treasury bounced about 20 basis points, landing to the lowest levels seen under the current administration. Short-term pricing indices. LIBOR reform takes the spotlight as far as benchmark pricing indices. British regulators announced the planned removal of the LIBOR index by 2021. Banks, agencies, insurance companies and other financial institutions have relied upon this index for decades. That said, few lenders are concerned since numerous indices emerge as probable replacements, including the broad Treasury repo financing rate, BTFR, and the bank prime rate. The more laborious issue focuses on financial institutions to modify documentation that corresponds to the new indices. New construction. Many funding sources are flush with cash for making construction loans. However, looming concerns about certain sectors of the commercial real estate market facing overbuilding, mainly multifamily, demand that banks and other construction lenders tighten underwriting standards, or even retrench from such opportunities. Yet the overall state of supply and demand is reasonably balanced. Retail and office sectors are limited to build-to-suit/per-leased properties, while industrial development remains healthy, including spec deals. Now more than ever, new construction opportunities are funded on a very selective basis, generally based upon lower loan-to-cost ratios of 65% or less. The Real Estate Capital Institute's director, John Oharenko, advises, even as short-term rates remain very attractive, the pricing gap compared to long-term rates is very tight. He adds, it clearly makes sense to explore long-term debt, but with favorable prepayment privileges, the best of both worlds. November 1, 2017. Real Estate Capital Scoreboard-November, 2017. Chicago, Illinois, November 1, 2017. This month, Fed holds rates unchanged, but realty capital markets are less predictable. From the equity perspective, investors scramble to find any type of favorable commercial real estate yields, a daunting task. From the debt perspective, mortgage pricing and higher leverage debt still favors multifamily transactions, but other CRE deals are gaining favor, especially loans with lower leverage requirements. The most relevant capital market topics discussed today include: solid economy. Unabated strong economic performance leads experts to believe that a 2% annual growth rate is acceptable, along with 1% growth in employment. These growth rates help to support record low mortgage delinquency rates. Conservative lending combined with constrained supply also keep CRE on a stable, steady path. Value add. The value add investment realm is the most crowded space for fundraising. Abundant bridge, mezzanine and preferred equity funding sources populate the capital landscape, yet fewer opportunities generate targeted returns in the lower single-digit range. Borrowers looking for such funds mostly weigh these costs against their equity yields, which may be more competitive. Grade compression. Along the same line of value-add discussions, pricing between ABC-grade properties is extremely tight. Capitalization rates on Class A versus Class C properties is as narrow as 200 to 300 basis points, nearly half the spread difference seen only a few years ago. In select markets, the flight to higher quality assets can be an easier buy on a risk-adjusted basis. Sector plays. Retail property investing is the most battered sector in the industry, plagued by technological displacement and oversupply. U.S. retail property inventory is approximately 25 feet squared per person, by far the highest ratio in the world. Simply too much space exists in the market, even without factoring the impact of internet shopping habits. However, retailing is evolving very quickly, and well-located properties providing enjoyable shopping experiences not available online will be clear winners. The Real Estate Capital Institute's director, John Oharenko, says, steady rates lead to extremely competitive pricing on purchasing assets, as the cost of debt becomes less of an issue regarding volatility.
December 1, 2017 Real Estate Capital Scoreboard-December, 2017. Chicago, Illinois, December 1, 2017. As the year is wrapping up, few investors worry about any damaging market conditions in the foreseeable future. Unfortunately, easy money deals seem to be gone for now, and profits much harder to hunt down for the following market comments. Values dropped, but prices haven't. After years of steady price appreciation, many markets now in supply and demand balance. Buyers have flatter profit expectations. Big data brings instant pricing feedback, but sellers aren't motivated to adjust expectations as quickly. Institutional buying activity dropping, but private buyers are stepping in. Favorable climate for purchasing core rather than value-add deals, as too many investors chasing higher yields. Lenders are not chasing the market. Funding sources are competing for deals via spreads not in leverage, as more lenders enter the debt markets, including Wall Street. The conduit industry adopted very effectively to risk retention regulations, assuring strong underwriting discipline. The plethora of other sources including debt funds, life companies and banks keeps pressure on spreads, even as benchmark rates rise. Borrowers often find lenders crossing traditional paths, with winning bidders difficult to predict. A great time to shop the market, especially for lower leverage loans. Millennials want housing. The new frontier of realty profits are being discovered in the single-family housing market. Heavily punished during the Great Recession, home builders cautiously return with expectations of 5% or more growth next year. The timing could not be better, as pent-up demand from millennials and natural population growth greatly overshadow existing housing stock. The insatiable demand is stymied by restrictive consumer lending, rising construction costs and limited availability of sites in more desirable urban locations. Developers are creatively working with capital sources to formulate optimal financing strategies for homeowners, for example, Builders pay for student loans. However, apartment demand will hardly be dented by housing growth, as ownership costs are still beyond reach of many in the population segment. John Oharenko, director of the Real Estate Capital Institutes, states, as commercial real estate gains more institutional ownership share, dramatic price volatility will subside for core assets. Value-add and smaller, entrepreneurial properties will behave more cyclically.